Anyone can beat Wall Street at their own game if they learn the 5 big takeaways from this book. Starting with takeaway number 1, why the amateur can beat the pros. Surely the retail investor doesn't stand a chance against the might of Wall Street. After all, they are armed with Ivy League analysts, Bloomberg terminals and snow. Given that these institutional analysts spend 80 hours a week searching for bargain stocks, surely there isn't anything left for peasants like us. According to Peter Lynch, this assumption is dead wrong. In fact, the professional investor has many disadvantages compared to the amateur. Number 1. A successful fund manager attracts a lot of capital, but the more capital you have, the fewer opportunities you can invest in. For example, a $10 billion fund cannot invest in a company with a market cap of $10 million, even if it's the best opportunity in the entire stock market, because it's too small to have a meaningful impact on the fund's overall performance. More money, more problems. Fortunately, I'm problem-free. Number 2. Mediocrity is the safest play. There's a saying on Wall Street, you'll never lose your job losing your client's money in an IBM. If you invest in a stock that you thought had big potential and it doesn't pan out, you will lose your job. But if you stick with the herd, even if the investments underperform, you're more likely to keep your position. Number 3. Institutional investors tend to spend about 25% of their time explaining to various shareholders about why they made certain investments in order to keep their minds at ease. This is time they could spend searching for investment opportunities, or they can just pretend to work like I do. Number 4. Fund managers are investing other people's money. Therefore, it's those people who decide how much money the managers have at their disposal. The problem is that these individuals are often not savvy investors. They tend to withdraw their money during bear markets and invest more during bull rallies. This is exactly what you should do if you want to work at Wendy's for the rest of your life. This leaves the manager with the dilemma of having too much money when everything is expensive and too little when everything is cheap. Does the individual investor have any of these disadvantages? No, in fact, the amateur investor often has a great advantage over the professionals, which we'll discuss in the next takeaway. But before that, could you spare a moment to like, subscribe, and comment which book I should cover next? Takeaway number 2, the amateur advantage. If you're a software engineer, a cashier at Wendy's, or like me, homeless, you have an edge over Wall Street. We all have certain industries, products, and services that we know more about than the average person. This is information that Wall Street either doesn't know about yet or has had to spend hundreds of hours on market research to uncover. Peter Lynch famously said, if you like the store, chances are you'll love the stock. Think about it, which everyday products do you enjoy and use from publicly listed companies? Here's a list of some of mine. Jack Daniels, canned beans, Jack Daniels. Takeaway number 3, the 6 categories of stocks. Not all investment opportunities are created equal. To lump them all together and treat them the same way would be a foolish and unprofitable strategy. Peter Lynch argues that there are 6 distinct categories of stock investments. The first category is slow growers. These are typically large companies operating in mature industries with expected growth in the low single digits. Investors usually buy into these companies for their dividends rather than capital appreciation. Peter Lynch isn't particularly fond of this category of stock. He argues that if the company isn't growing fast, its stock price likely won't go very far either. The second category is stalwarts. These are the in-betweeners, not fast growers but also not slow growers. An earnings growth rate of around 10% is typical for this category. Generally, you'll want to sell these stocks after they make a quick 30 to 50% gain. The third category is fast growers. Fast growers are aggressive new enterprises, typically growing at 20% or more per year. If you can determine that a company is likely to sustain this growth for several years, it could be a great investment. The fourth category is cyclicals. These are companies whose revenues and profits rise and fall with the business cycle. They typically produce goods and services that consumers can delay purchasing during times of financial uncertainty. A good example of a cyclical industry is the travel and leisure sector. People tend to cut back on vacations, flights, or luxury travel during economic downturns. But as the economy recovers, these industries often see a surge in demand. If you can identify early signs of a booming or busting cycle, you'll be in a great position to take advantage of it. The fifth category is turnarounds. Turnarounds involve companies that are facing declining earnings or have problematic balance sheets that have the potential to recover. If the company avoids bankruptcy and manages to get back on track, the shareholders get rewarded. One interesting aspect of turnarounds is that their ups and downs aren't as closely tied to the overall market trends as the other categories. A company with a temporary bad reputation, perhaps from a scandal or one-off event, can often be a profitable turnaround opportunity. Sixth category is asset plays. This involves situations where a company's true value isn't fully recognized by the market. The company might possess valuable assets that the market has overlooked, like real estate, natural resources, or even tax losses, which can be used to offset future earnings. Benjamin Graham, the father of value investing, was a strong advocate of this approach. He famously looked for companies where the value of their assets exceeded their market capitalization. He would then simply wait for the market to realize its mistake and correct the stock price accordingly. He also famously invented the swap, swapping your wife for your secretary. When using these categories, it's important to understand that companies can belong to more than one category simultaneously. Also, much like people, companies don't stay in the same category forever. Take me for example. I used to run a hedge fund, now I work behind a Wendy's. Takeaway number 4. 10 traits of the 10-bagger. A 10-bagger is a term Peter Lynch uses to describe a stock that increases to 10 times your purchase price. Landing just a few of these during your investment career can cement your status as an investing legend. 1. The company name is dull, or even better, ridiculous. Such companies tend to be overlooked. 2. It does something dull. 3. It does something disagreeable. Even better than producing something dull is producing something disagreeable. A good example would be tobacco companies. 4. Institutions don't own it and it's not followed by any analysts. Such companies haven't been discovered yet by the big players, which gives them extra upside potential. When giants like Vanguard and BlackRock start buying, it can send the stock price to the moon. 5. There's something inherently depressing about it. Burial service companies are a classic example. 6. The company's industry isn't growing. In high-growth industries, thousands of people are constantly trying to capture a share of the market. On the other hand, companies in stagnant industries face less competition. 7. It's got a niche. These are the companies with moats that Buffett famously looks for. 8. It has recurring revenues. The product is a subscription or something that is consumed, so customers come back for more. 9. Insiders are buying. Insiders might sell their shares for any number of reasons, but they only buy for one. They think the price will rise. 10. The company is buying back shares. If a company has faith in itself, it should invest in itself. Peter Lynch prefers share buybacks over dividends. Takeaway number 5. 5 traits of the reverse 10-bagger. 1. It's in a hot industry. As previously mentioned, everyone is looking for ways to enter these booming sectors, and competition is usually a bad omen for profits. 2. It's the next something. Beware when something claims a company is the next Nvidia or something similar. Usually, it's not. 3. The company is diversifying. Some call it diversification, but Lynch refers to it as diversification. If a company is acquiring businesses in unrelated industries, don't buy. 4. It's dependent on a single customer. Some companies rely on one customer for a significant share of the profits. This creates a weak bargaining position, leaving the company vulnerable to being squeezed or losing its main source of revenue. 5. It's a whisper stock. These are long shots, often believed to be on the verge of achieving something miraculous, like curing all diseases, creating world peace, or going up after I buy it. All of this is explained in greater detail in the book One Up on Wall Street. I'll leave a link to it in the description. But if you're looking for more horrible investing advice, check this video instead.